the Fed will have to be even more dovish. And I think that's why stocks can rally even more than they have already.
Everybody, and I mean literally everybody, is making a crap ton of money in the stock market right now. And what Tom Lee is about to say is probably going to be a little bit shocking because he's basically saying that this rally is just getting started. He's not calling for a crash. He's not calling for a dip. He's not even calling for a market breather. He's going to lay out a situation for the market in the next 2 years, how regular people just like you are probably going to get rich if you capitalize just right.
All right, so Tom, we said this a bunch of times. The market seemed to be shrugging off the shutdown, valuation concerns. What do you think is going on? Why do investors just continue to feel confidence?
Frank, I think there's two underlying fundamental drivers for the economy. One is that we know there's a tremendous capex tailwind from AI. And the second is that the Fed's been on hold for 9 months, and it's kept the ISM below 50 for now 31 months, and the Fed's dovish. So that's the rest of the economy getting basically a lifeline. Those are going to be powerful tailwinds that even a government shutdown doesn't really change the story around. And now that we're in the seasonally strong fourth quarter,
So before we go any deeper into Tom Lee's interview, he's talking about two critical things right now that are potential humongous tailwinds for the market. Number one is going to be that the AI capex spending is still extremely strong. Companies like Meta, companies like Google, like Tesla, companies like that are building out their AI data centers like crazy. That is spurring the economy right now, and that is spurring demand for these chips. AMD is making money, Nvidia is making money, TSM is making money, SMCI is making money, Dell's making money. You get it. The companies that are helping integrate these data centers are making a boatload of money. Now, there are a couple flip sides I could do in this argument, and it could be like this. What happens when capex spending slows down? Once you get the majority of these AI data centers built out, do you really have to spend as much money every single year just refreshing it and getting new chips as new ones come out? The answer is probably going to be a no. But at the end of the day, I could flip that again and say companies like Meta that are spending roughly 40% of their revenue on capex, and a lot of that is going towards AI data center build out. When they stop spending that capex money, where's that money going to go? It's going to go to the bottom line as earnings per share. And again, you know what happens when earnings per share goes up. The stock price typically goes up too. And then the second thing, the Fed is pretty much ready to cut interest rates. I have talked about so many times on this channel that interest rates are like gravity in the stock market. As rates go down, stocks become more compelling because interest rates are lower, bond yields are lower, and nobody wants to waste their time with that stuff. If you could get 10% in the stock market, but a 3% bond that you have to go pay taxes on semi-annually, nobody's going to want to waste their time in a bond and then pay taxes and probably not even outpace inflation. So the stock market is really becoming the only game in town. And the shutdown that we're in right now at the time of recording this video, I don't really think it's that big of a deal. Sometimes it's a buy the dip opportunity if we even get a dip, but this shutdown, we didn't get a dip and it just seems like nobody really cares. And on top of that, the fourth quarter is typically a pretty strong time of the year where the market's probably going to rally going into the end of the year. But again, Tom Lee's about to talk about valuations and how we're maybe in a bubble, but also he's going to lay out his situation how valuations actually might be cheap because we might be looking at this wrong.
and valuations, I just don't think are that demanding because, Nvidia is still at
Mhm.
26 times earnings. I mean, I think stocks still have a lot of upside into year end.
So I've always harped on this from day one on this YouTube channel that whenever you listen to people talking about data, you have to understand the specifics. So I pulled up Nvidia, I pulled up their price earnings ratio level, and this is forward price earnings ratio level, which will make the number lower because it's factoring in forward earnings that haven't even happened yet. If we look at that, you could see that coming off of the April 8th low, yes, Nvidia's PE ratio is roughly 20 for the forward, which is pretty fair considering how fast they're growing. But if you see, the stock rallied and also the price earnings ratio rallied with it, and right now we're trading at roughly a 42 for the forward price earnings ratio level. So what Tom Lee is talking about with his price earnings ratio level is he might be taking 2027 PE, he might be taking 2028 PE. We don't really know. And this is common what happens in the stock market when valuations are often pretty stretched because analysts often want to fit their agenda of saying, hey, there's still steam left in this bull market, but they don't tell you how are they making their numbers fit the narrative. He's taking earnings per share from a couple years in the future, bringing that to right now, but nobody on earth really does that when you analyze a company for price earnings ratio level. Typically, you'll do trailing earnings, which is the past year, and then you'll do forward earnings, which is a 1 year going ahead. So just by looking at this chart, yes, the price earnings ratio level is up there. It's roughly 42-ish. Is it high? Yes, but also their earnings per share growth is really high too. So we will see what happens for Q3 when NVIDIA reports, and we will get a little bit more color on if this is actually sustainable to trade at a 42 PE ratio level.
Okay, I want to get to your word of the day. It's dovish. Now, this is interesting. Your word's dovish, and you're dovish because the Fed didn't get the jobs report and might not get other reports. Why are you dovish, or you think the Fed's dovish, despite that critical information?
I just want to chime in really quick and say I would be completely shocked if the Fed does not have the jobs report or something similar to give them, hey, is the data good or bad? This is the Federal Reserve of the United States. They are going to pay whatever it takes to get the stupid jobs report. So I don't buy the fact that, hey, Jerome Powell doesn't have the jobs report. Just wanted to say that real quick.
Well, the Fed has, I think, on balance, has to be more dovish than what they said they would be last month, because a government shutdown, as you know, disrupts economic activity. So even though they're not getting reports, there's also a standstill in GDP, and the government is a very large share of GDP. On top of that, it causes confidence to be weaker. A shutdown makes people nervous, and so the Fed will have to be even more dovish, and I think that's why stocks can rally even more than they have already.
So if we just listen to that and just take it at face value, sure, it sounds good. Interest rates are going to go down, the stock market's going to rally. But what you have to understand is Tom Lee is alluding to the fact that Jerome Powell is cutting interest rates because the economy is slowing down, because the economy is losing jobs. Why are we cutting? Because there's weakness out there. And typically when the Fed cuts going into weakness, it usually foreshadows a potential recession. So yes, in theory, on paper, yes, cutting interest rates makes the stock market go up, but you're cutting because something bad is happening. That is usually not good for the stock market. And something that I've been saying from day one also on this channel is this idea that which scenario would you rather have? A strong economy with slightly higher interest rates, or a terrible economy with pretty much interest rates at 0%. Me, myself, I mean, sure, I'll say give me the bad economy so I could buy the dip and go buy real estate with really good interest rates. But at the end of the day, what's better for the whole world? You want a strong economy with slightly higher interest rates, because interest rates are high because there's a demand function right there. There's more demand than there is supply. That's why inflation's a little bit higher. That's why interest rates are a little bit higher. And also this idea that, let's say we cut interest rates all the way down to 0%. Then what happens if we have a recession? What if we have a slowdown? How is the Fed going to stimulate the economy? I mean, you can't cut below 0%. And the benefit of being at 4%, which is what we're at right now, is that if things hit the fan, we could cut from 4 to 0 overnight to help bring the economy back and drive some demand. But if we keep cutting into this weakness, we're only going to be able to cut so much. And then if something bad really were to happen, how much more can we do to try to save the economy?
All right, you're also looking at seasonality. You alluded to it earlier. According to your data, since 1950 in Q4, we see just about an average rise of about 5%. But when we're talking about seasonality, are you sure this isn't an outlier year? As we mentioned, a government shutdown, companies trying to deal with tariffs. We're seeing a trade war between the U.S. and China continue. It hasn't quite been resolved yet. I mean, aren't there some issues that could maybe shake the seasonality here?
Yes, that's right. I mean, seasonality is just a base case, so things can make it different. But this year, we're going into the fourth quarter where sentiment, I think, is still really muted. If you look at things like AAII net bulls, it's barely positive. After a 30% rally in stocks, historically, you'd be solidly positive on a 20-week moving average of that number. Investors have really been skeptical this entire rally. That's why we call it the most hated V-shaped rally.
So I do think that Tom Lee pretty much nailed that right on the head, because we could just look at that same chart, consumer sentiment index going all the way back to 1980, and you could see that right now we are pretty much down the tubes for consumer sentiment. So if you just think about this logically, if everybody is talking crap on the economy and on the stock market and they're pessimistic about their job, maybe they're going to lose their job, maybe they're not going to get that pay raise, they're going to report bad on this consumer sentiment index. So when all the people are pessimistic out there, they're going to be like, well, I'm not going to put my money into the stock market. So there seems to be this idea that there's so much money on the sidelines in the stock market that if it were to take a dip, maybe these people will come off the sidelines and go buy the dip. Like if we were up here like in we'll just say 2018, this sentiment index is very high. So when the sentiment index is high and the stock market happens to go down, there's not going to be much money on the sidelines to buy the dip, because when sentiment's high, everybody's money is already in the stock market. But when sentiment is low like it is down here, maybe the money isn't in the stock market yet, but if we get a dip, they will put it in. So that is kind of the bullish argument, because yeah, maybe there is a bunch of money on the sidelines that will come into the market and buy the dip. But also I'm going to flip it on the bearish side just so you could get both sides of the argument. And I'm going to say this: if the sentiment is low, people probably aren't going to put their money in right now at all-time highs, so they're definitely not going to put their money in when the market dips, because think about it. When the market dips, you have Jim Cramer going on TV, you have all the major headlines running of, oh my God, market turmoil, market crashing, don't buy the stock market, it's going to keep going down, valuations are going to be a bubble. Like, when the market starts to take a correction, all those headlines are going to come out, because mainstream media is only going to report about what's the hot thing to talk about right now. And the hot thing to talk about is the market's going up, AI is great, and CapEx is strong. That's what's hot right now, and that's what gets clicks. But when the market falls, takes a little bit of a correction, they're going to be talking about valuations and the fundamentals, and maybe this AI bubble is blown out of proportion. Whatever it may be, they're going to talk about the negative stuff. And you got to understand that the typical retail investor, they don't have a clue what they're doing. So if they're nervous right now when the market's at all-time highs, they're probably going to be more nervous when the market falls, and they're probably definitely not going to put their money back into the market. So again, I do agree with Tom a little bit there, but again, my bearish thesis, I feel like, is a little bit stronger thesis than his bullish thesis.
All right, I'm going to get to your pick as well. Your pick for us today is financials. Now, is this on the idea that the Fed is dovish, rate cuts help, boost the yield curve, and that helps financials, or is there some other reason that you're saying that you would put money into financials right now ahead of earnings?
Well, I think financials have also fundamental tailwinds, because we know the Fed is going to be dovish, which is helpful for economic activity. But on top of that, AI is a tool that the financials industry can leverage. It's going to help them root out fraud. It's going to help make their businesses more profitable. And it's something we've talked about at Fundstrat, which is the financials may end up getting technology valuations, especially given blockchain and moving from traditional financial rails onto blockchain and becoming more efficient.
So remember, cutting interest rates because the economy is slowing down, that is not bullish for the economy. If we just cut interest rates to get back to neutral, sure, that's great. But the Fed typically never cuts for that reason. They're cutting right now because the labor market's slowing down, the economy is slowing down, and Jerome Powell knows that inflation is not as much of a worry because there's not as much demand out there in the economy. And for financials, I do agree with Tom Lee that they're fundamentally so much cheaper than the rest of the market. And if financials do get re-rated as tech companies, like tech companies right now average at like a 40 price earnings ratio level, but many of these banks are below 20 for a price earnings ratio level. So if they happen to get re-rated from 20 to 40, which honestly is kind of unlikely, but if it does happen, that would imply the stock price is going to double. So I am personally looking at financials right now. I'm going to add a few plays in my portfolio just to capitalize on this idea that financials are cheap. Maybe we'll sell some puts, maybe we'll buy some calls, maybe we'll buy some shares, but we're not going to overweight our portfolio on that too heavy. There are other opportunities out there that I am capitalizing on right now. So again, if you got value from this video, drop a like, drop a subscribe. It really helps out the channel a lot. And if you want to watch a pretty good video of me laying out my bullish and bearish scenario for the market, doing all the fundamentals and all that good stuff, watch this video right here. It's going to help you guys out a lot. See you there.